Despite what we're being told in the mainstream media, everything is not going well. We are encountering unprecedented levels of stimulus and still the markets are struggling. $15 trillion worth of money printing plus the secret $16 trillion Fed bailout and deflation is still the central banker's biggest fear. Housing has fallen from its peak in most major global cities, debt has skyrocketed on all fronts, and every word the Fed says sends a shockwave through the market. It's a disaster waiting to happen. You came here for the truth, so let me unveil that for you. Today we're going to look at the asynchronous global economic collapse. I want to cover various issues. We're going to look at real estate. We're going to look at the Fed. I want to show you what's happening in China and Japan. I've got a lot to cover, and I wanted to begin by taking a look at this. You're looking at the WTI crude oil, and it peaked out over $75 a barrel in October, at the beginning of October. It just happens to coincide with Powell's comments about how we're a long way from neutral. And ever since then, crude oil has fallen. Today, it's approximately $50 a barrel, and you're seeing that it happens to coincide also with the stock markets. Now, is that such a coincidence, or is it directly related to the fact that traders, whether human or algorithm, are relying on the central banks and their policies of easy money? And as soon as there's a tightening, that puts the fear into them, and that begins a contraction. Every time we see the Fed suggesting that, well, you know what, maybe we're not going to tighten so much, the stock market rises immediately. Immediate effect in that respect. So then we can continue on by looking at the S&P 500. It is almost a mirror image in the fact that Powell's comments sent the market tanking, and where it peaked out on that same exact day, as far as I'm aware, it has been unable to recover to its previous highs. Now, while the S&P 500 has performed better than oil since the beginning of this contraction, there's no way to deny that they are both directly linked to what Powell said. The simple matter of fact that he said perhaps we're going to start tightening increasingly throughout 2019. Therefore, the markets priced it in immediately and it started to fall. Let's look at this. San Francisco median single family house price, it peaked out earlier this year at $1.7 million. Now we're back to the levels from May of 2017. Obviously, it's still very, very high. It looks like it's about 1.4 million, and that is a significant drop off from the 1.7 million it was at earlier this year. Now, certainly it could turn around. However, as long as the monetary conditions are in a tightening cycle, there's no way that assets in general can rise. And that is a matter of fact. It's historically documented, and certainly we are seeing just the tip of the iceberg for real estate today. Credit cards and debt in general is expanding to levels we have never seen before, and this is starting to come back and produce a negative effect on the lenders. Credit card delinquencies, application rejections, and involuntary account closures are all on the upswing, according to the Fed. The Fed says that these developments are potentially concerning given the strength of the economy and the comparatively low interest rates. Trends most likely indicate that credit card companies issued debt too freely in the preceding years. Do you think that could be possible? Were they giving out money too easily? Or should we give out some more free money? Because that happens to be the solution in every single case. But they could also signal that lenders are bracing for an economic downturn and paring back risk accordingly. Sure, they want to be very risk adverse. They want to have to put their protections into place and ensure that everybody is taken care of. We don't want a problem. We don't want another crisis. And they're certainly going to cut back on their profits. Oh, I'm very sure about that. Lender-initiated account closures increase. You can see here just showing you the differences, but interconnected with that, transition into serious delinquency by origination credit score. Just looking at the fact that a lot of these individuals here are becoming delinquent. A lot of them happen to be within the less than 620 credit score, but on the whole, they're all rising right now over the last few years. And that shows us that people are taking on more debt, but if they can't pay it back, suddenly they start to default on it and the lenders get screwed over. And then of course we have the derivatives, which are all connected with all of this debt. It starts to unravel the whole mess. US household balance sheets. You could see how much wealth people have today, how incredible it is. Tangible assets, financial assets, compared to liabilities, looks fantastic, looks wonderful, whether it's the equities and real estate and mutual funds and so on. That sounds really, really good. However, we just got one problem with that. First of all, part of this $26 trillion worth are pension funds, and we know what's going to happen to them, but we're not allowed to talk about it because people get really scared. So I guess I'll move on. Looking at this, household assets, liabilities, and net worth happens to be increasing since the financial crisis. That's a positive factor, right? However, there's just one little step that this doesn't mention. When you look at the statistics, you're going to see only a small piece of the puzzle. It's never telling you the entire story. You need to follow all of this information, get the truth, get the details, so you can figure out the fact that, oh, wait a minute, all of that stuff is owned by the top 0.1%. Not by the bottom 90%, but by the top 0.1%. They own it all. And yet, you can see people cheering. They think everything is just fine. And of course, in the next crisis, which we will have, which our good friend Janet Yellen seems to deny, we can see that this will in fact make a major impact on the middle class. It is going to be so devastating. There is no question about it. Now we're looking at China and Japan. First, China, you can see the M1 and the M2 year-over-year growth. Both of these are stagnating, and it has shown us that even though the national team has been coming in and buying up shares, they have relaxed the lending standards. They've made it much easier to get loans. They've been trying to force feed this market into new growth, and yet still it has been slowly but surely evaporating. Looking at Japan's M1, year-over-year growth has come down as well. From January 2017 up until present day, the growth has slowed down by a few percent, as you can see here. And looking at the Bank of Japan's stealth tapering. Now, they haven't made it a policy that they're actually reducing their balance sheets or that they're going to print less money. They suggested that they will buy everything and anything as long as it means that the market will stay alive and will not crash. That's what they're deciding to do. That is the policy that they've set out. However, they've actually started to reduce the amount of money that they print. BOJ adopts yield curve control policy in September 2016. You're looking at the increase in the BOJ's junk bonds as far as I'm concerned, but it's Japanese government bonds. I call them junk bonds. Looking at this from a peak of 80 trillion yen down to a level that's basically about half of that today. So that is quite a bit of a decrease that we're seeing here, and there's no telling how far they're going to go down. I don't know how they're even surviving at this point, but miracles certainly do happen. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can find everything you need from the foundation, the history, the asset classes, and of course, how to make money and so much more. So check them out at the link in the description. If you're more interested in the audiobook version, that's available at themoneygps.com. I got the podcast on iTunes now. You can check that out if you want to see me on there. It's the same exact videos are automatically put up to iTunes podcast, so you can see that as well. Take care. If you're still here, just a bonus article, because if I put this into the video, there's a couple people that get triggered by it. So I put at the very end of the video here. And I just wanted to show you an example of how you can have your own banking system fail you. You have so much money in your banks in general. People take all of their savings, they put them in there, they think that they're insured. But what if you can't get your money then what? What good is that money to you? It has no value. What does anything have in actual real value? It's what somebody will pay for it. But if you can't even get it, then basically it's worth nothing. SoftBank's mobile service outage Thursday across much of Japan's disrupted operations, ranging from flights and trains to amusement parks and logistics companies, illustrating both corporate and consumer dependence on wireless communications networks. So here they are, they can't get in to their banking systems, they can't get into their financial systems, they can't move the money around, and this is the result of all of that, the chaos, the panic. And sure, it's something that was resolved on a relatively quick basis, but what happens when money can't move? Well, everything stops, everything freezes. People trust these systems and then they get screwed over by them here and there, but in general they operate at a pretty good consistency, so people feel confident. And I think that what we need is to have less confidence in them. That's all I'm trying to say. So that's all. I'll end it there. Take care.